When I was working as a financial advisor, last week would have been a stressful one at the office. Markets are down quite significantly. We're seeing various different changes to the Bank of England's strategy with interest rates and others around the world. And we've still got that AI problem rumbling on. So here's the major market headlines from last week and what they mean for you, your money and your investments. Hi, welcome back. My name's Zoe and this is my channel Words on Wealth. And every Monday I give a breakdown of some of the major headlines from last week and translate them into what it actually means for you, your money and your investing portfolio. So let's get straight into that first topic, which kind of not the elephant in the room, but it's certainly one that all of us will be aware of. It's the ongoing tension that we're seeing now in the Middle East and the escalating war that is now taking place. When it first all kicked off, markets were responding in a relatively chilled fashion. There was certainly some wobbles, particularly around energy prices, but it seemed to be at first that this could be relatively short-lived. In the last week, what markets seem to be accepting is that actually it may well drag on for a bit longer, and there's therefore been a bit of a shift. Most major stock markets fell off the back of this shift in the kind of view that actually, it is going to take a bit longer and we're not therefore super optimistic about a bounce back period. One of the only sectors to have come out of last week in the green was energy providers, because oil prices again went back up, despite the fact that there had been releases from governments of stockpiles of oil to try and abate the price, but it's just not really worked in quite the way that they wanted. We could argue, of course, that they've helped keep it down a little bit lower than they might have otherwise seen, but at the moment oil is still above the $100 per barrel point, and that is seen as, I discussed last week, quite a psychological point. And what that means is that for markets, that psychological point has been breached, and therefore they're pretty worried about what is to come. Because higher energy costs means potential for higher inflation, and that feeds into everything. It feeds into higher costs across the board. It feeds into, therefore, consumers and businesses spending less. And as a result, it generally means a slowdown, not just in economies, but also in stock markets as well. Some major energy infrastructure has also been hit and targeted as well, with the potential for future issues around this coming up in the Middle East. And this again just pumps more fear into the markets of a wider knock-on effect globally. Of course, we are globally interconnected, and whilst the war is concentrated at the moment in the Middle East, we are seeing the impact across the world, because things like the Hormuz Strait, which is a major shipping lane in the Middle East but therefore takes goods across the globe, is at the moment a real target and has been at the very least blocked, at some point certainly closed, and it all just slows down that global trade and the potential for stock markets to keep going and to pick back up again. So what does all this mean then for you and your investments? Well, for me, the key takeaway of this is it looks like it's going to be a bit of a longer term impact, and so expect a bit of a longer term downturn in your investing portfolio. It doesn't need to be dramatic, but certainly if you've looked at it over the last week, things might not have looked quite as rosy as you might like them to, and prepare mentally now for that to potentially carry on for a bit longer, particularly if we see the likes of major energy networks being hit, and therefore a greater potential knock-on impact on energy prices and things like inflation as well. From a money perspective, we might also start to see that creeping inflation again, and what that could mean is a little bit of uncertainty and prices going up. There's no guarantees quite yet. Most of us will have probably seen prices creep up already at the likes of the petrol pumps, but the impact into other goods, maybe not quite there yet, but do prepare that that could be something that is coming. It's always there, so don't see it necessarily as like, oh, flipping heck, here we go again. There is always some level of inflation, or at least governments always want some level of inflation around the 2% mark. It's not necessarily a hugely bad thing. In fact, it does often come with economic positives. But we may well see, therefore, some shifts in attitudes and, again, hounded by some media headlines, some of which may be helpful, some of which may be less so. So prepare yourself for that too. Which brings me on to the second major story of the week, which is all about interest rates. So generally, what most governments and central banks have done is control inflation with interest rates. Now that has two main effects, just to recap. First and foremost, it means that anybody with a loan that is paying an interest rate on that loan will see the price of that go up. That means they've got less money to spend, there's less money in circulation, and it helps to bring inflation down. The second main effect is that anybody who has cash in savings that is earning an interest rate will see that go up slightly. So they've got more incentive to leave their money in the bank account, not spend it, earn a little bit more, and therefore, again, there's less money going into the economy being spent and circulating around, helping to bring inflation down. Now, with interest rates, what we've seen over the last few years, particularly in the UK and across the US and many European countries as well, is that interest rates had gone up along with inflation. And a lot of that was off the back of the conflict that took place or is still taking place in Ukraine. That conflict similarly spiked energy prices, pushed inflation up to 10% in some places, including the UK, and as a result, central banks had to leap on those interest rate changes. Now, since inflation started to come back down again in the UK, we're hovering just over that 2%, 3% point that the government wants, so it's almost back in line to where we want it to be. We've seen interest rates come down as well, and the Bank of England has started making interest rate cuts. Last week, there was another decision made that actually we're not quite ready to reduce interest rates again, as many might have hoped. This is because there's a big fear that inflation could go back up again off the Middle East conflict and whatever else is going on in the rest of the world as well, with inflation creeping up in different countries too. The Bank of England wasn't the only one to have made this major decision. There were many others, including the European Central Bank, and the Fed also met to discuss interest rates, and many are taking a similar approach now of it's just time to have a pause and not make any big changes because of what is now going on. Now, whilst these parts of interest rates going up and down might not sound necessarily bad, generally what we see is that when interest rates are higher, and therefore loans are more expensive and people are incentivized to leave money in cash, whilst it does help to bring down inflation, it's not superbly great for economic growth because people are spending less. And so, as a result, many will see from a stock market perspective that these interest rate pauses and looking ahead, these interest rate forecasts of, we're not too sure actually when these are going to come back down, based on the fact that we're thinking this conflict could go on for a bit longer, it's not looking super positive. What we might start to see is that actually we do see a bit of slowing from an economic growth perspective, or at least that's the indication that these interest rate changes, or lack of changes, are giving. And so what does this mean then for you and your investments? From an investment perspective, not loads. It ties into that first point, which is that we're certainly seeing a bit of a sluggish end to now this conflict that is looking like it's going to drag on. From your money and what's going into your pocket perspective, we may well see that inflation does continue to creep up. If you've got a variable mortgage where you're paying a loan that could change, these interest rate pauses aren't necessarily a bad thing, but you might have wished for them to come down a little bit. Equally, if you're looking for a mortgage, we might well start to see that interest rates come up even a little bit within mortgage deals, as there's potential fear, not necessarily for central bank interest rates to come up, but again, thinking about that future. And as for money in cash, it might well look quite similar. They're not going down quite yet, so you're not going to get even less for leaving money in cash, but they're certainly not going in a way that is boosting the likes of stock markets. Which brings me on to my third and final story of the week, which is actually all about AI. Now, before the conflict in the Middle East kicked off, I felt like one of the main topics that we were talking about on the stock market was AI and the potential for an AI bubble. It was pretty much what was dominating financial and investing and stock market headlines. Since that conflict has kind of taken over, we've seen very little about it, or at least I feel like it's certainly taken a back seat. But it's still there. For me, there were two big stories that kind of went under the radar last week about AI. First was all about Walmart, a major supermarket chain in the US. They've started steadily introducing patterns on various parts of their AI products, one of which is looking at dynamic pricing. Now, you might be familiar with dynamic pricing from either the Oasis concert ticket saga here in the UK, or from simply using Uber late at night. Essentially, the prices change as and when things get more or less popular. kind of ebbing and flowing with supply and demand. It literally is supply and demand playing out in real time. Now, what Walmart are potentially going to do is start using dynamic pricing in their shops. Over the last few months, they've been introducing electronic price tickets in the vast majority of their stores. So they could potentially, if there's a run on bananas, increase the price of bananas to make more money. Now, for many, this is seen as quite controversial from a consumer perspective. It may not garner particularly loyal customers if things are going to start changing a lot, as and when there's a rush on bananas. You get the idea. It's using AI in a relatively savvy way, but potentially one that isn't great for consumers. But it may make Walmart money, which has been one of the key topics behind AI and their overall bubble. The second major story is behind the company Palantir. Now, Palantir are a really controversial company that use AI a lot for data processing. They have some major contracts, including with the US military and the US government as well, notably and controversially with their ICE program. Now, Palantir has just got a contract with the FCA. They are the financial watchdog, financial authorities here in the UK. The contract that they've got with them is all about trying to look at the data behind the likes of fraud and also white-collar crimes. Now, again, it's not necessarily about what they're doing within the FCA. That's not what I'm focusing on right now. What I'm focusing on is the fact that they're using AI. But crucially, they seem to be using AI in a way that is making money. Now, as I say, one of the main topics behind this stock market potential bubble with AI is how is AI actually going to make money? For me, these two stories start to quietly highlight how we might be disadvantaged as consumers and we might not like the ethics behind the AI, but they are starting to weave in and prove ways that they can start to make money via these big contracts, via things like dynamic pricing, which in turn, when we come out the other side of this conflict with the likes of the Middle East and whatever else kicks off in the world in the meantime, who knows, then we might start to see actually the tails around the AI bubble dissipate if they can continue to find these ways to perhaps make more money and be a little bit more dynamic, pardon the pun, in the different ways in which they're doing. So there you have it, the three main headlines from last week and what they mean for you, your investments and your money. Do make sure that you like and subscribe if you're enjoying these, and do make sure you're back here again next Monday for a little update. And of course, if you see anything in the headlines, drop it in the comments for me and I'll do my very best to weave it in, break it down and analyse it for you as well. Have a great week.